New York City, the summer of 2001. The World Trade Center stood as a symbol of American ambition, twin giants piercing the sky. But behind the steel and glass, a quiet business deal was unfolding that would change insurance history forever. Enter Larry Silverstein, a determined real estate developer with big dreams. On July 24, 2001, just 6 weeks before tragedy struck, Silverstein Properties signed a 99-year lease on the entire WTC complex for $3.2 billion. It was the deal of a lifetime, or so it seemed. Little did anyone know, the insurance policies he rushed into place would soon be tested in the most catastrophic way imaginable.
With the lease signed, Silverstein moved fast. He secured property insurance worth $3.55 billion per occurrence, a tiny word that would soon spark a billion-dollar war. Terrorism coverage was included, but the formal policies weren't even fully written yet, just binders. Brokers scrambled. Insurers like Swiss Re, Travelers, and others signed on. The key question no one asked: what exactly counts as one occurrence? 2 planes, 17 minutes apart. Would that be one coordinated attack or 2 separate events? Silverstein's team believed they were covered for the worst. They had no idea how soon that coverage would be put to the ultimate test.
September 11th dawned clear and bright. Then, in the space of 17 minutes, 2 hijacked planes slammed into the Twin Towers. The world watched in horror as the buildings collapsed. Silverstein, watching from his apartment, immediately called his team. Start the claim process. The destruction was total. Over 2,700 lives lost, billions in property damage. But for the insurers, the nightmare was just beginning. Silverstein filed for the full policy limits, ×2. He argued the 2 plane strikes were 2 distinct occurrences. The insurers pushed back hard. This was one coordinated terrorist event. The stage was set for the largest insurance dispute in history.
Larry Silverstein wasn't asking for a normal payout anymore. He wanted up to $7.1 billion. Why? Because he argued the 2 plane impacts were 2 separate occurrences, which would double the insurance limit. The insurers were stunned. This wasn't just another claim. It was potentially the largest insurance payout in history, and they refused to accept it. So the battle moved straight into federal court in Manhattan. That's where things became incredibly complicated. The insurance policies weren't even fully standardized. Some companies had agreed to temporary will prop forms that leaned toward defining the attacks as one occurrence. Others used completely different wording. Suddenly, billions of dollars depended on which version of the paperwork actually applied. Silverstein's lawyers argued he was a businessman trying to rebuild Ground Zero after unimaginable destruction. The insurers fired back.
Justice
they
will
had never
prevail.
calculated risk
Your
for
truth
2
is a
hijacked
fantasy.
jumbo jets
We
striking
have
the
the
same
evidence.
complex within
The
minutes of
verdict
each other.
is mine.
What followed wasn't just a legal fight. It became a war over language, interpretation, and the future of one of the most important sites in America.
In 2004, the battle exploded into 2 separate trials. The question sounded simple. Was 9/11 one attack or 2? The first jury sided with most insurers, ruling it was a single occurrence. But months later, a second jury looked at the same tragedy and came to a different conclusion. 2 separate occurrences for other insurers. Suddenly, billions of dollars were hanging on one interpretation. Appeals flew back and forth for years as both sides refused to back down. Larry Silverstein had pushed for a full double payout under the insurance policies. He never got the entire amount he wanted, but the pressure worked. In 2007, the war finally ended with a settlement of around $4.55 billion. Not the full jackpot, but still one of the largest insurance payouts in history. And at the center of it all was a single overlooked word in the contracts. One word that triggered years of courtroom battles, massive legal.
With the settlement money finally in hand and some very tough negotiations with the Port Authority, rebuilding slowly began. New towers started rising from the ashes, including the shining One World Trade Center we see today. For Larry Silverstein, this was the fight of his life. He had put everything on the line: his reputation, his fortune, decades of experience in real estate. The emotional and financial stakes couldn't have been higher. As one of his lawyers later put it, it came down to intent versus wording. What everyone thought the policy meant versus what the actual fine print actually said. Billions were won and lost on that single distinction. Timeline-wise, it had all unfolded like this. The lease signed in July 2001, the attacks in September, the first trials in 2004, and finally
The lease was signed in July 2001. The attacks happened just weeks later in September. The first courtroom battles began in 2004. The massive settlement finally arrived in 2007. For a moment, forget the billions and the legal headlines. Step inside that courtroom and imagine being one of the jurors sitting there. Hour after hour, they listened to lawyers argue over insurance language so complicated it sounded almost impossible to follow. But underneath all the legal jargon, the case came down to one brutally simple question. Was 9/11 legally one occurrence or two? The lawyers tried to make it easy for the jury. One occurrence meant one insurance payout. Two occurrences meant double the money. And suddenly, every single word inside those contracts became incredibly important. You could actually feel the confusion building in the room. It was the same tragedy, the same day, the same horrifying attack, yet both sides were telling completely different stories. One team argued that two planes hit 17 minutes apart, making them two separate events. The other side pushed back hard, saying it was clearly one coordinated terrorist attack carried out under a single plan. And the tension inside that courtroom was unbelievable, because this wasn't just some technical legal debate anymore. Billions of dollars were hanging in the balance. Now, here's the part where the story gets really fascinating, because this tiny legal detail is what turned the entire case into a billion-dollar battle. In the insurance world, the word occurrence has a very specific meaning. It basically refers to the single event that triggers the maximum payout under a policy. Sounds simple enough, until billions of dollars are attached to it. Think about it like a car accident. If one crash happens, that's clearly one occurrence. But what if two different cars hit you a few minutes apart? Depending on the wording of the policy, some insurers could argue that those are actually two separate occurrences. And that exact argument exploded inside the World Trade Center case. Because if the attacks counted as one occurrence, the payout would be limited once. But if they counted as two separate occurrences, the payout could potentially double. Suddenly, one single word inside an insurance contract became worth billions of dollars. And there was another layer most people never heard about. These insurance policies had been reinsured, meaning huge companies across the world had quietly shared pieces of the financial risk. So a major loss wouldn't just hurt one insurer, it could send shockwaves across the entire global insurance industry. That's why the courtroom fight became so intense. The contracts had originally been rushed through quickly, and almost nobody realized at the time just how important the exact wording inside those Now let's talk about Larry Silverstein himself, because this part of the story feels almost unbelievable. This wasn't some lucky accident or random twist of fate. Long before the attacks happened, Silverstein had made one of the biggest and riskiest business moves of his entire life. In July 2001, just 6 weeks before 9/11, he signed the massive lease for the entire World Trade Center complex. It was an enormous deal, worth billions, and with it came huge financial pressure and responsibility. But here's what made the situation even more remarkable. Silverstein pushed aggressively for major insurance protection, including terrorism coverage, something many people at the time barely considered necessary. That decision would later become the center of one of the largest insurance battles in history. And it's important to understand the scale of the gamble he was taking even before the attacks ever happened. Managing the World Trade Center wasn't just another real estate investment. The costs were enormous. The risks were
After
massive,
9/11,
and his
the
own
insurance
reputation
industry was
tied
in
directly
shock.
to whether the deal
Companies
succeeded.
suddenly realized something terrifying. A single terrorist attack could create losses so massive that entire insurers might collapse overnight. And that fear spread fast. Insurers started pulling back from covering terrorism at all. Office towers, airports, stadiums, huge properties were suddenly struggling to even get insurance. Without coverage, construction projects stalled, businesses froze, and parts of the economy started panicking. So the U.S. government stepped in. In November 2002, Congress passed something called the Terrorism Risk Insurance Act, or TRIA. And this law changed everything. TRIA basically created a federal safety net. If another massive terrorist attack happened, the government would help share the financial losses, instead of leaving insurance companies to absorb the entire disaster alone. That one decision stabilized the market. Insurance companies regained confidence. Businesses could buy coverage again. Construction resumed. Investors stopped fearing total collapse from another attack.